something else that might be of use to you, and that if the market turns down again in the coming days, right, you can use it to help yourself. Okay, so for that purpose, I'm just going to speed through right all the way to the end, and then after that, we can go through a bit about China. But I would think Louis Wong would be better at going through the China portion with you, so I'll just talk to you a bit about this technique. Okay, now is using A50 futures to hedge your portfolio. Okay, I'm just going to go through with you today. Whether or not you want to utilize it is up to you. This is an option, right? Where if you use it, right, you don't have to think about, okay, should I sell my shares? Should I buy some more? You can just hold on to it, wait for the recovery, and then meanwhile you can do something else, right, to help yourself in the market downturn. Okay, let me just give you an example. Okay, since today we're talking about A shares, right, I'll use A shares as an example. Okay, you have a portfolio of A shares. Okay, and the A50, okay, when I did this seminar was about 2 weeks ago, and I mean, miraculously, it's really 10,000 points right now. Okay, that's A50 now at 4 to 10,000 points. Okay, now you have a stock portfolio, correct? Now you're looking at a portfolio. Okay, let's say it was $15,000, your entire stock portfolio, and then it started to bleed. Okay, it bleed until $11,000. As an investor, you ask yourself, what should you do? Okay, should I sell? Should I buy some more? Should I liquidate half? Should I buy other things? Should I diversify into other global shares to help myself? Okay, don't look any further. Okay, just use these futures, right, to help you, what I call, cushion your fall in the interim. Okay, this beta thing, right? Okay, you can just ignore it. Okay, let me just show you a few examples. You understand what I'm talking about already. Okay, this whole idea. Okay, your portfolio is bleeding. So what do you do when the market is turning downwards? Okay, the answer is this. Okay, you just have to short A50 futures. If you hold and you buy shares already, right, the only way to hedge, right, is to short A50 futures for A shares. Okay, if you're holding US shares, you go and short the S&P or Dow Jones futures. You hold Singapore shares, you go and short the SIMSKI futures. As long as you hold shares, your hedging tool, your hedging leg is to go and short the futures. Okay, I'll show you an example. How does this work? Okay, ignore the beta again. Okay, now let's say the example. Okay, market go up 1%. Okay, just say generally, let's say your entire portfolio go up by 1.2%. Okay, example, right? Just now your shares, right, has already fallen to $11,000, correct? Now, on the other hand, you have this contract with you also, but you have shorted it. Okay, what happened is this, okay? If your portfolio go up 1.2%, as you have said earlier, how much your portfolio make? 1.2 times 10,000 is $660, okay? And your contract, right, on the other hand, right, because the market go up 500 points, but you short, correct? So you lose $500. Okay, what happened to your net result? You net plus 160. Okay, this is just an example. You may win more, you may lose some, but overall, right, your net, right, it tends more to zero. Okay, you know what I mean? Okay, I go through with you again. Okay, let's say market goes up 500 points. Okay, 500 points is like about 1% of the market. Okay, can you understand? 500 points, 1%. Let's just say your entire stock portfolio somehow went up by 6% instead. Can you understand? So your stock portfolio go up 6%. Okay, so it goes up $660. But you lose money on your short futures because you short but it went up, so you lose $500. Net result, you earn $160. Okay, that is example number one. Okay, now conversely, if the market continue falling, what happened? Okay, let's say the market continue to fall. Okay, fall down by 500 points, and then your portfolio, so this should be goes down by negative 6%. Okay, what happened? Your portfolio similarly was $11,000. You this time on your shares, right? You continue to bleed. Okay, make no mistake about it. You continue to bleed and you lose $660. But on your futures, right, you plus the $500. Okay, so what's your net result? Your net, you only lose $160. Okay? Now you see, that's the whole idea. Okay, because you have this thing to help you. Instead of losing $660 in this market downturn, right, you are helping yourself lose lesser, or you are eliminating your downside risk. Okay? Conversely, if the market turns up, right, by right, of course, you're supposed to earn plus 660 lah. But because you are protecting yourself, right? This part eats in your profits, you only earn $160. Can understand? So can you see what you're doing? Once you hold long your shares, you short your futures, whatever happens, right? Market go up or go down, you are more or less guaranteed, right? A small plus or minus kind of situation where you don't really lose and you don't really gain also. Can you understand? Whether market up or down, your losses and gains are minimized already. This is a period where I call it the blackout period. Okay, you just don't want to think about it. You just want to protect yourself from downside. Okay, so you ask me, okay, so let's say market go down, okay, and after it recover, what should you do with the futures? You just sell. Correct, you don't have to hold on to it forever, you know. This one, you think market go up sufficiently already, you think you do it, this thing will help yourself anymore, just close it. And then you can continue holding your portfolio without having to think about whether or not you need to force sell your shares. And at the same time, right, you minimize all these market fluctuations in this very volatile period. Okay. How much future contract need you buy to hedge, say 10,000 or 11,000? Okay. Let me okay, on that question, right? Okay, this gentleman just asked how many contracts do you need to protect yourself on a portfolio? Now, A50 contract, right, is one of the smallest contracts around, so it's the easiest for you to hedge. Once you have the approximate ratio, I would say is about $10,000 per one contract. That means if your shares are total worth $10,000, right, you just need one contract to hedge. If you have 20,000, you take 2 contracts. If you have 100,000, you take 10 contracts. Okay, it's an easy calculation. You can just go back and work out the math. Singapore shares, I'm sorry, not so easy to do because SGX, the contract, so somehow, right, is very big. So unless you have $100,000 worth of shares with you, right, then you can consider, okay, let's buy one contract to protect yourself. But otherwise, there's no meaning. That's why I'm not talking about SIMSKI futures. Okay, US also easy to do because there's mini Dow, mini S&P. Okay, but as long as your A shares are concerned, it's the easiest because there is the contract value is very, very small for A50. Yes, it's in US dollars. Okay, don't care about the beta, don't care about anything else. Okay, all you need to know is that regardless of how volatile your portfolio is, right, the moment you hold shares and you short futures, right, your gains and losses, right, will enter a period, right, where fluctuation will be very little. Okay, you don't make much, you don't lose much until you feel comfortable to let yourself be exposed to the market elements again. Then you close out the contract and then you enter the market again. Ken? For the A50 is $1 per index point, which means now it's about 10,000 US dollars. But of course, you don't need 10,000 US dollars. You only need about, I think, 1,001 to open one contract. Okay, put in 5,000, it's safe. I think you hardly get a margin call. Most probably not. 5,000 US dollars. Yeah, I think you hardly get a contract margin call unless the market really turns sour like Monday. Okay, so I'm giving you an alternative. Okay, instead of what happened to S&P 500 last night? They go back into marginal gains, marginal losses. Like think about it. Thursday was plus 4%, S&P 500, right? Thursday was plus 2%. Friday is plus 0. Okay, law of diminishing returns. Okay, plus 4, plus 2, plus 0. Monday would be the do or die day. Correct. Whether or not it continues the downtrend or not, we see Monday already. Towards the bounce is finished. Alright, so if the bounce if it really happens to be a bounce and the S&P 500 falls on Monday, right, it means downtrend resumes. Correct. This is when honestly this tool will really come very handy for you. Okay, instead of thinking should I average down or can buy already not, bottom already not, just think about something else and use this to help you meanwhile. Okay, instead of losing $660, you only lose about 160. Still lose, okay, but not so painful. Okay. Now, now with that, any questions about this alternative strategy that I've just taught you today? Okay, so what I need you all to do, right, is very simple. Okay, I'm not trying to hard sell, but I think since May or June, right, I've been. If you attended my interest rate seminar, right, when I felt that the Fed would increase rates in September, right, I said third quarter will be volatile and things will start moving. And don't see second quarter so quiet, nothing is going to move. Third quarter is a different story. I've been saying that since May. And I tell them already, please open a futures account because when the September rate hike comes, most market other than the US dollar would likely trend downwards. and the only way to catch a falling market is to go short the market. And I say, please go and open futures account. Please go and open futures account. Please open futures account. But nobody open futures account. I don't understand why. Okay, never mind against next already. Now, as a fellow investor to a fellow investor, okay, please go and open a futures account later so that you can protect yourself from further downside. Okay, gains never mind. Next time I earn again, but don't take losses. Okay, please go and open a futures account so that you can protect yourself from the market downturn in the coming days, which I think will continue to happen. Okay, it's a personal plea. Please, don't wait already. Really, don't wait already. Okay. Okay, now let me go back to the start of the topic on China, where we are going to with the A50. And I did this 2 weeks ago, so I think some of the numbers you see there might be a bit outdated, but I think most of it have come true. And yeah, it's just a sign of how tough our times are. Okay, now we just go through a bit roughly today. I think my gist here today really was to tell you how to hedge your portfolio instead of going through the outlook. I think Louis Song will be better at that for me. But let's go through a few topics that are popular right now. Yuan devaluation, and how bearish I think the A50 is, and of course the portion of how to hedge your A50, how to hedge your A shares, which I've already done. Okay, now last time I spoke to you on a large scale, I think it was the shares investment seminar. Other than the fact that I went to the PICs, I think I spoke to you on the A50 seminar on 23rd of May. Okay, and what did I say back then? I said that, okay, hey, look, we are in probably for one last ride because due to under the Elliott wave theory, it should go higher. And what else did I say? I said that, okay, but it looks a bit fishy because A50, right, it's not rising high. But for some reason or another, right, the Shanghai Composite, right, is already rising higher already. You look at the black color bar, okay, it's high, while the green color bar is still lagging the Shanghai Composite. So I told the investment seminar back then that you can still go long now, but at the first sign of trouble, take money and zao, okay? Don't wait anymore already. And it really proved to be true, correct? We spoke here 23rd of May. It still went up a bit, about 7%. Then it exploded. And of course, I did this. It was still 10,800 points. I think it went down to about 9,000 on Monday or Tuesday. So let's not talk about it, how bad it has fallen. Okay, so there are many reasons for the crash in A shares. I think it started off with not being included in the MSCI mix. I'm not sure if you remember that issue, but it looks very small right now. And then there were a series of things that the government tried to do with little avail. And then they had cracked down on share financing. They had trading hot and many other things like that. Okay. Now let's not go through this because it's very boring. But this essentially is all the policies that the PBOC tried to roll out, but it didn't support the market at all. And why didn't the central bank policy support the stock market? It's a very simple reason. It's because 80% of the stock market, right, is retail players in China. Okay, it's a very peculiar market. Okay, now imagine, right, all of us here, right, are the market today, and your portfolio dropped $10. The next time you go back $10, right, will you take and run or not? You will, right? You won't see already. And in a market that is dominated by retail players, right, they are going to face such issues. They'll be more irrational, like things like they'll panic sell, or they over leverage, or they buy when it hasn't bottomed out yet. The kind of very funny things. Okay, so that is why the government policies didn't work. US might work because there's a lot of hedge funds, there's a lot of institutional players on there, and they know what they're doing. And anyway, the money is not there, so they can take the proper risk management road. But in a market that's 80% retail players, you get a lot of irrational results instead. Okay, now let's talk a bit more about the Chinese yuan devaluation. I think that is more interesting. Okay, so much for the stock market crash. This made everything worse. And I think this was an event, right, that triggered the meltdown in Asia, especially our Singapore counters. Okay, now this was 10th of August. They cut one time on Monday. Then this was 11th of August. They cut it for a second day on Tuesday. And then this was 12th of August. And then they cut it for the third time on Wednesday. Okay, and they cut it 3 times in a row. And okay, this yuan devaluation brings so many talking points on so many different levels. Okay, you talk about Obama's dealing with China also can include. You talk about China's trying to isolate US also can talk. Okay, but the way I see it is very simple. They are desperate already. They cut rates, didn't work. They increase the reserve requirement ratio, didn't work. Okay, it's one thing to go and touch your interest rates and deal with the capital market, but for you to directly interfere with the FX market, right, is really desperate already. Okay, that's how I see it. Okay, so this is a long line of their of their monetary easing policies, and it still didn't work. Okay, and of course it tells you how deep China's slowdown is at the moment. Okay, forget about the growth story already. It's over. They are now officially in a slowdown, and in a slowdown that is worse than we think it is. Okay, so now you think about it, right? Since 2008, right, China has did a lot of this heavy lifting. Correct. Now in the era, right, in 2008, when the US cut all their interest rates, put in the QE, Japan did that. I think most of the world also did some form of QE one way or another. China, right, was the only man, okay, in the world. They stood still and they continued to let the currency appreciate. And they took in all this deflation right around the world from 2008 to about 2014. Now and of course, back then they also had a bit of I think they cut credit also. They eased the credit restrictions so that companies can borrow and grow more aggressively. So that part from China, right, helped to ease out the 2008 crisis actually. Okay, back then, who was the Chinese president? I think can't remember him. Saturday morning, so I can't remember. Zhu Rongji, is it? I can't remember. Wu Jintao probably, yes. Okay, he eased the credit restrictions. So the growth by the Chinese companies, right, helped the world through 2008. Okay, so now you tell me China, okay, wave the white flag already. Okay, who's going to provide the leadership here? Who's going to be the one to absorb all these negative inflows? And who's going to be the one to provide the growth if a crisis happens again, which looks like it's happening again? Okay, and that's why the world is panicking. That's why you see all this selling off of Chinese shares. Now, okay, so there's this just an awful look about it that okay, we are in 2015, but it looks like we have gone all the way back to 2009, 2010, where we are a bit recovering, but then the world still looks very fragile again, and all the headways that we made from 2010 to 2014 looks to have disappeared with the wind. Okay. Now, there's an issue of currency wars with the Chinese yuan devaluation. Okay. Now, actually, what you're trying to say here is that actually the yuan's devaluation, right, is not much compared to the rest of the emerging markets. Okay, green line is the US dollar, yellow line is Brazilian, red line is European, the blue line here is Mexican peso, and your China is here. And actually, they haven't devalued much. Okay, but I would like to say that although the Chinese didn't devalue much, but you cannot compare like for like that. It's different. Okay, if your superpower devalue money, right, got a big problem. Your Cyprus devalue money, right, no problem. Okay, so I don't think this is a very fair comparison. And of course, I think this picture suits what we are seeing better. Okay, once your superpower devalues your currency, right, you can be pretty sure that there will be a chain of reactions across the region. And I won't be surprised if the likes of Japan or Taiwan or South Korea or Australia or even Singapore start to go and ease their monetary policies just to keep up with China's easing. Okay, and if you ask me, right now, I did a model on my own, and you ask me, right, the Singapore dollar, right, looks awfully strong right now. I'm not sure about you, but I think the Singapore dollar looks quite pretty strong. Other than the fact that it fell against the US dollar and the pound this year, it has actually risen against most other currencies, and it looks to be like one of the all-time high right now, according to what my model suggests. And if I'm not wrong, we might see a round of easing from MAS in October. Okay, I might be wrong, but we'll see how again. Okay, so don't expect all these countries to sit back and do nothing. Okay, this move by China might trigger a new wave of monetary easing policies from the rest of the world. Okay, and there are other concerns about this yuan devaluation. Okay, you devalue your yuan, right? What happens? Okay, your goods become cheaper, correct? Because you can buy more Chinese goods now, so your goods become cheaper. Okay, and then if your goods are cheaper, right, the US are paying lesser for your goods, so the import price falls. And then Americans buy cheaper Chinese goods, correct? So the inflation doesn't rise, and then the Fed delays a rate hike. Okay, there are other implications to think about. Okay, so that's why I say this yuan devaluation really triggers a lot of talking points and a lot of food for thought. And for that reason, right, honestly, you ask me right now, will the Federal Reserve raise interest rates in September? I am not sure anymore. Okay, I think even the Federal Reserve themselves are not sure anymore. And I think they're just waiting to see how everything goes. Maybe they see the non-farm payrolls next Friday to see if it's a good number or not. But I think they don't know also. And I won't be surprised if they delay to December. So you are saying China devalue the yuan, cheaper Chinese goods, and it probably impact most other countries around the world. Okay, you are spreading your deflation problems to other countries. Okay, so the only plus side I can think of Chinese devaluing their yuan is that you get cheaper Christmas gifts this year, but otherwise, honestly, there's nothing good to come out of it. Okay, so I think we are in tough times. I think you also know that, and all I can say right now is be cautious, be careful, have the necessary tools to help you to protect yourself during this market downturn. And one of it is to, of course, open a futures account. Okay, it's free and it doesn't cost you anything, so it really doesn't harm you to open one and then think about it when you really need it. Okay. Now, we've been saying this for a while since July. I think that we've been bearish, and it's volatile. I wrote this, and I wrote this, and I wrote this. Okay, but due to the lack of time, I'm not going to go through this. Okay, but when I did this 2 weeks ago, I felt that the support levels were at 10,000 and 8,008, and definitely this has been breached. Can anyone tell me the intraday low this week was how low? About 8,000. So it's about this level. Okay, so we are crossing two support levels to about this level already. And we have since rebounded back up to 10,000 if I'm not wrong. But I think we might still see a bit of downside pressure from now to the end of the year. Okay, so all I can say is take care and good luck, because I'm in the same boat as you. Now, okay, I say this already. Okay, there's one more thing that I want to go through with you. Now, if you really just insist on buying shares, you don't want to listen to me about A50 hedging and whatnot, okay? Now, go and consider, right? This is the only thing that you want to consider is consider shares, right? They are dual listed on both Hong Kong and China for a simple reason, because these shares are cheaper on a PE point of view. Okay, let me show you how much cheaper they are. Okay, your Shanghai Composite is about 19 times PE right now. I mean, that was 2 weeks ago. Okay, and your AH shares, that means shares that are dual listed on both Hong Kong and China, is only about 9 or 10. Okay, example of a dual listed stock is, I think, what's the thing called? Ping An Insurance Group. But no worries, okay, let me tell you where to find this group of shares that are dual listed. Okay, you go to volumes, you click on the financial markets. Okay, you want to write down? Yeah, click on financial markets. Then you click on here, foreign markets. And then you click on this, China, sse-a-sh-h-k. And then you get the end. China, sse-a-sh-h-k. That means the second last one. There are two Chinas. Let's take the top China one. Okay, this one is the Hong Kong and China. The second one is Shanghai and Shenzhen. So take the first one. Okay, and then you get the entire list. These are stocks that are listed both on Hong Kong and China. Okay, you can find it on the Poyon's website. Okay, so you can take a look at it if you really insist on buying, which I really don't encourage, but I cannot say it because because I'm employed by Phillip. Okay, sorry. Yes, I think so. I think it's Poyon's one, right? Yeah, I think it's Poyon's one.
You can't short those A shares.
No, you're able to short shares. So I'm not very. Oh yeah. No. Is this? Okay, one or two. I think it works the same. You just have to click on financial markets, and the links are the same. Okay, so you just follow the same steps. Okay, financial markets. Then you click here. They bring you to this page. You click on down there, foreign markets, and then you click on this China, sse-a-sh-h-k. Okay, if you still want to buy and you cannot resist buying, these are the ones that I would suggest to you. Okay, it's a bit funny. Okay, H shares opening, right, are influenced by how the Dow closed last night, but intraday, right, it will be influenced by how the China market moves. Okay, so H shares are a bit like a cross hybrid right now. But the thing is, because because China has a certain amount of restrictions to how much foreigners can buy in. So that's why, due to the distortion in demand supply, right, the shares are a bit more expensive there. Because as you know, even if your Connect program, right, there's only a certain limit to how much foreigners can buy in. But for H shares, they are open to the rest of the world. So yeah, prices are a bit cheaper down there. Okay, now I've gone through this, okay, but I cannot emphasize this enough. It's a very important and it's a very useful tool for you to have during a market downturn. And all I can say to you is that hedging allows you to limit your losses, also limits your gains. Okay, you don't have to hold on to the contract forever. Once you think the downturn is over, you can just close the contract. Okay, no big deal about it. Remember, you're not seeking to make profits during this period. You are seeking to reduce your losses. Okay. Now you can hold on to your shares, okay, without fretting whether you should sell it or not, and then you can wait and continue with your buy and hold strategy for the long-term outlook. Okay, so all I can say to you is like, don't wait until market turn again. It takes us some time to process your account opening form. Okay, it's not say today you open, today you have already. It takes us some time to go through our credit admin unit, and then after that, you must send in for processing. I don't know. I think MAS want to see, SGX want to see, DCN want to see also. I'm not sure. Okay, but take some time on. So open today, so that by the time you need it, you have it on hand. If you really want to use it sometime down the road. Okay, so conclusion. Okay, a lot of problems for China. The government interventions are not working anymore, and the yuan devaluation will bring a lot more problems than you can think it is. So we are in a very volatile and uncertain period of time. How you protect yourself is, okay, go and open a futures account. Let you go and hedge yourself against your current portfolio. Okay, I'm not trying to ask you to go and trade often. Okay, I'm just asking you to protect your portfolio of shares. Hey, don't wait for market crash to happen before opening account. Okay, but then too late already. Okay, don't wait anymore. Now I'll pass my time to Mr. Louis Wong, who have more knowledge to explain to you the market outlook for China. Okay, Mr. Louis Wong.